If I told you that a $2.4 billion loss didn't actually threaten JP Morgan at all, but still made parts of the financial system tense, you'd probably assume nothing important happened. If I told you that a single price level, $67.30, forced large institutions to adjust positions automatically, not emotionally, not strategically, but mechanically, it might sound exaggerated. And if I told you that what people call Monday panic has nothing to do with fear and everything to do with how modern financial systems are wired, you might wonder why no one explains it this way. But this is exactly how the system works. If you hear that JP Morgan lost $2.4 billion, the natural reaction is to assume something went wrong. A bad trade, a miscalculation, a mistake that should have been avoided. But in modern finance, that assumption is often incorrect. For institutions operating at the center of the financial system, losses do not always represent failure. Sometimes they represent friction, the moment when a system under pressure begins to push back. And that distinction matters, because what people casually describe as Monday panic is rarely panic at all. It is not fear. It is not emotion. It is not investors suddenly changing their minds overnight. It is mechanics. Modern financial markets do not primarily respond to opinions or headlines. They respond to rules, thresholds, and automatic adjustments that activate when specific conditions are met. Once those conditions are triggered, discretion disappears. This is where the number $67.30 enters the story. To most people, it is just a price on a screen. But inside the system, that price level interacts with leverage limits, margin requirements, collateral rules, and settlement obligations. When price approaches certain zones, positions must be adjusted immediately and automatically. Not because anyone wants to act, but because the system requires it. That is why Monday matters. When markets close for the weekend, unresolved pressure does not disappear. Contracts still exist. Obligations remain. Risk does not pause. When markets reopen, anything that could not be adjusted earlier must be resolved at once. This is why what looks like panic often appears right after the open. But again, it is not panic. It is settlement. Margins reset. Leverage is recalculated. Risk models enforce compliance. For an institution like JP Morgan, this environment is familiar. For more than a century, it has not operated like a typical bank. It has functioned as a structural institution deeply embedded in the machinery that keeps markets liquid and obligations honored. When conditions are calm, that role fades into the background. Everything appears normal, efficient, stable. But when pressure builds, institutions at the center feel it first, not because they are reckless, but because they are essential. Modern financial systems are no longer physical in the way they once were. They are digital, automated, and layered with contracts that move enormous amounts of money in fractions of a second. Futures, options, swaps, and hedges dominate how prices are formed. Physical assets still exist, but they function mainly as anchors. Price discovery happens on screens. And when prices move too far, too fast, those layers of contracts begin interacting in ways the system struggles to smooth out. Liquidity thins. Flexibility shrinks. The margin for error gets smaller. That is where JP Morgan lives, right at that intersection. Its role is not to speculate. Its role is to stabilize. It provides liquidity. It manages exposure. It keeps markets functioning when conditions are normal. But when the structure tightens, when margin buffers shrink and liquidity becomes selective, even stabilizers feel the impact first. So the $2.4 billion loss was not a failure. It was a message, a signal that the system's ability to absorb stress had narrowed. Economists often describe this phase as compression, when adjustments that once unfolded over weeks or months are forced into hours or days. This does not mean collapse. It means the system is operating with less room to breathe. History shows this pattern again and again. In every major financial cycle, pressure appears first at institutions sitting closest to the system's core. Not because they are weak, but because they are exposed to every moving part at once. When liquidity tightens, they feel it. When collateral values shift, they feel it. When interest rates move faster than models expect, they feel it. JP Morgan's balance sheet becomes a map of invisible stress. This has happened before. In the early 20th century, the firm played a direct role in stabilizing the American banking system during a national panic. In 2008, it absorbed failing institutions to keep the financial plumbing from seizing up. Each time, the same pattern appeared. Pressure showed up there first, not as collapse, but as signal. And those signals always arrive before the headlines. What matters now is not predicting what comes next. It is understanding how the system behaves when it tightens, and why numbers like $67.30 can force action even when no one feels afraid. That understanding begins with mechanics, not emotion. To understand why a price like $67.30 matters, you have to understand how modern markets manage risk. Not emotionally, not intuitively, but mathematically. Large financial institutions do not decide risk on the fly. They operate inside frameworks built around leverage limits, margin requirements, collateral rules, and settlement schedules. These frameworks are designed to keep the system stable during normal conditions. But they also create pressure points, specific price zones where flexibility suddenly disappears. $67.30 was one of those zones. At certain price levels, the amount of leverage allowed on open positions changes automatically. Margin requirements increase. Collateral demands rise. Positions that were acceptable a few dollars lower are no longer acceptable at that level. This is not a judgment call. It is an instruction. When price crosses into these zones, systems do not ask whether the move is temporary or permanent. They do not wait for confirmation. They enforce rules immediately. That enforcement is what people mistake for panic. But nothing is panicking. Risk models are recalculating. Margins are being called. Positions are being resized. This happens whether institutions agree with the move or not. For firms operating at scale, this creates a unique problem. The larger the balance sheet, the more tightly it is bound to these rules. Size brings influence, but it also brings obligation. Large institutions cannot simply wait it out. They must comply in real time. This is why price levels matter more than narratives. News can be debated. Opinions can differ, but price interacts directly with structure. When price reaches a level like $67.30, it intersects with leverage caps, margin thresholds, and delivery obligations simultaneously. That convergence forces action across multiple layers of the system at once. And once action begins, it spreads. Positions are adjusted. Liquidity is sourced. Exposure is reduced. Not because anyone expects disaster, but because the system demands alignment. This is especially visible at the start of the trading week. When markets close for the weekend, unresolved pressure does not disappear. Contracts still exist. Risk still exists. Obligations remain. When markets reopen, anything that could not be resolved earlier must be resolved immediately. That is why Monday matters. What looks like sudden movement is often delayed adjustment. The system is catching up to conditions that already exist. Margin calls that could not be executed on Friday must be executed on Monday. Leverage that became excessive over the weekend must be reduced at the open. This creates the appearance of panic. But again, it is not panic. It is timing. For an institution like JP Morgan, this timing is critical. Its role places it at the center of settlement, clearing, and liquidity provision. When price triggers mechanical adjustments, JP Morgan is often involved in executing them. That exposure does not mean the institution caused the movement. It means it is positioned where the movement becomes visible. This is why losses can appear even when no one made a bad decision. A $2.4 billion loss at this level does not imply mismanagement. It implies that the system reached a point where flexibility narrowed faster than positions could be adjusted without cost. That cost is the signal. Economists describe this stage as compression for a reason. The system is still functioning, but it is doing so under tighter constraints. Adjustments happen faster. Margins shrink. Errors become more expensive. This is not collapse behavior. It is transition behavior. History shows that financial systems often pass through these phases quietly. The system adapts first. Behavior changes second. Headlines come last. This is why watching institutions at the center matters more than watching prices alone. Prices show movement. Balance sheets show stress. And when stress appears at the core, it tells us something important. The system is still working, but it is working harder. By the time the broader public notices these shifts, they have usually been underway for some time. The most meaningful changes do not announce themselves. They reveal themselves through structure. Not loudly, not dramatically, quietly, through structure. When moments like this happen, they often feel new, unique, unprecedented. But history suggests otherwise. Financial systems have always revealed stress the same way. not through sudden collapse, but through pressure appearing at the center before it spreads outward. Long before the public feels anything, institutions closest to the system's core begin reflecting strain. This pattern has repeated across different eras, different technologies, and different markets. The details change. The mechanics do not. In earlier financial systems, stress showed up through physical constraints. Banks ran low on reserves. Gold and silver left vaults. Credit became harder to extend. Adjustments took time because information traveled slowly. Today, information moves instantly. Contracts adjust automatically. Pressure that once took months to surface can now appear in hours. But the sequence remains the same. First, flexibility narrows. Then, central institutions feel it. Only later does it become visible to everyone else. This is why looking at history matters, not to predict outcomes, but to recognize process. In past financial cycles, institutions that played a central role in liquidity and settlement were always the first to reflect tightening conditions. They were not reckless. They were exposed. Their position made them unavoidable participants in every adjustment. When systems expanded, they absorbed growth quietly. When systems tightened, they absorbed pressure just as quietly. This is what made them early indicators rather than early casualties. The same dynamic applies today. Modern financial systems are far more complex than those of the past, but complexity does not eliminate patterns. It compresses them. It speeds them up. It makes them harder to recognize in real time. What once unfolded slowly now unfolds quietly and quickly. That is why moments like a $2.4 billion loss matter only in context. On its own, the number is not alarming. But placed inside the structure of the system, alongside leverage limits, margin frameworks, and settlement timing, it becomes informative. It tells us that pressure has reached a level where adjustment carries real cost. History shows that when systems enter this phase, behavior begins to change even if conditions still appear stable. Institutions become more conservative. Liquidity becomes more selective. Risk is managed with tighter tolerances. None of this happens because of fear. It happens because systems respond to constraints. This is also why these phases are often misunderstood. People expect change to look dramatic. They expect visible stress. They expect clear signals. Instead, what they get is normalcy with friction. Markets open on time. Prices continue to move. Institutions continue operating. But beneath that surface, priorities shift. Capital that once chased opportunity now prioritizes certainty. Leverage that once felt safe is reduced. Exposure that once seemed manageable is reassessed. These changes rarely make headlines because they do not feel urgent, but they shape everything that follows. This is why history often looks obvious in hindsight and confusing in the moment. The process unfolds quietly, and recognition comes late. Institutions like J.P. Morgan sit at the center of this process, not because they direct it, but because they record it. Their balance sheets reflect how much flexibility remains inside the system at any given time. When stress appears there, it does not mean something has broken. It means the system has entered a different phase, a phase where timing matters more, where margins matter more, where errors carry higher cost. History shows that these phases do not resolve quickly. They unwind gradually, as systems adapt to tighter conditions. Some adjustments happen smoothly, others are forced, but the shift itself is rarely reversed overnight. That is why moments like this deserve explanation rather than reaction. They are not endpoints. They are markers along a longer path. Understanding that path requires patience and an understanding of structure. Not panic, not prediction, but process. What makes the current environment different from past cycles is not the presence of pressure, but the speed at which that pressure is processed. Modern financial systems are built for efficiency. Automation has reduced friction, lowered transaction costs, and allowed markets to function continuously across time zones. Under normal conditions, this speed is an advantage. It allows capital to move quickly, risk to be distributed efficiently, and markets to remain liquid. But speed has a side effect. When conditions tighten, there is less time to absorb stress. In earlier eras, financial systems had natural delays. Information traveled slowly. Contracts were settled manually. Adjustments unfolded over days or weeks. Those delays acted as shock absorbers, giving institutions time to adapt gradually. Today, those buffers are gone. Prices update in real time. Risk models recalculate instantly. Margin requirements adjust automatically. Settlement obligations are enforced on precise schedules. Once thresholds are crossed, responses are immediate. This is why modern tightening feels abrupt, even when it has been building quietly for some time. The system does not warn. It recalculates. This is especially important for institutions that operate at scale. Large institutions do not simply hold positions. They clear trades, provide liquidity, and manage exposure across vast networks of counterparties. Every adjustment they make interacts with someone else's obligation. When speed increases, coordination becomes harder. A position that could once be adjusted over several sessions may now need to be addressed immediately. Liquidity that was once available across multiple venues may become concentrated or selective. Small mismatches between assets and liabilities can suddenly matter. This is how compression accelerates. The system does not fail because participants are careless. It tightens because the rules enforcing stability activate more quickly than flexibility can be restored. This is also why modern stress often appears technical rather than emotional. There are no crowds rushing to withdraw funds. There are no visible signs of panic. What exists instead is a series of automatic adjustments that ripple through the system faster than they can be explained. For institutions like JP Morgan, this environment creates constant exposure to timing risk. The institution must remain active at all times. It cannot pause. It cannot disengage. It must continue providing liquidity and clearing obligations even when conditions are strained. That role makes it sensitive to compression. When margins tighten and liquidity thins, the cost of adjustment increases. Losses may appear not because of bad decisions, but because the system forces alignment faster than positions can be reshaped without friction. This is what makes moments like a $2.4 billion loss informative. The loss itself does not define the situation. The conditions surrounding it do. They tell us that the system is operating closer to its constraints. This does not mean the system is unstable. It means it is less forgiving. Movements that would once have been absorbed smoothly now carry cost. Timing matters more. Precision matters more. This is the trade-off of speed. As systems become more efficient, they also become more sensitive. The margin for error shrinks. The tolerance for delay disappears. History suggests that once systems enter this phase, they do not immediately reverse course. They adapt by changing behavior. Risk is managed more conservatively. Liquidity is held more tightly. Exposure is reduced incrementally. These adjustments rarely attract attention, but over time, they reshape how the system functions. That reshaping is already underway. It is visible not in headlines, but in how institutions respond to pressure, in how quickly adjustments are made, in how selectively liquidity is deployed. This is why understanding mechanics matters more than reacting to events. Events are outcomes. Mechanics are causes. And the mechanics tell us that the system is not breaking. It is tightening. When people hear about stress in the financial system, they often imagine a single breaking moment. A crash, a freeze, a dramatic event that signals something has gone wrong. But that is rarely how modern systems change. Financial systems do not usually fail at their strongest point. They evolve at their limits. What we are seeing now is not a breakdown, but a transition into a tighter operating environment. A phase where the system still functions, but with less room for error, less tolerance for delay, and less flexibility than before. This distinction matters. A system that is tightening is still stable, but it behaves differently. Risk is priced more carefully. Liquidity becomes more selective. Institutions respond faster and more defensively. Small movements carry greater consequences. This is not fear-driven behavior. It is rule-driven behavior. The architecture of modern finance is built to prevent sudden collapse by enforcing adjustment early. That enforcement shows up as compression, the system narrowing how much deviation it allows. This is why pressure appears first in places that cannot step away. Institutions like JP Morgan do not choose when to participate. Their role places them inside every major adjustment. They clear trades, manage collateral, provide liquidity, and absorb timing mismatches between different parts of the system. When conditions are easy, that role is invisible. When conditions tighten, it becomes revealing. The $2.4 billion loss does not tell us that something broke. It tells us that adjustments became expensive. That alignment between price, leverage, and obligation happened under tighter constraints than before. And that is the signal. The number $67.30 fits into this story not as a prediction, but as a trigger point, a level where multiple rules intersected at the same time. When that happens, discretion disappears. The system responds whether participants agree with the move or not. This is why Monday panic is such a misleading phrase. There is no panic. There is scheduling. Markets close. Risk accumulates. Markets reopen. Rules enforce alignment. What feels sudden is often delayed. This is how modern financial systems translate pressure into action, quietly, automatically, without emotion. History shows that once systems enter this phase, they do not announce it. They adapt. Behavior changes gradually. Exposure is managed more conservatively. Liquidity is deployed more carefully. Over time, these small adjustments reshape outcomes. This is why understanding structure matters more than watching headlines. Headlines react to events. Structure explains why those events happen the way they do. The most important financial changes rarely arrive with urgency. They arrive with subtle shifts in behavior that only become obvious later. And by the time they are obvious, the system has already moved on. What matters most in moments like this is not the size of a loss or the institution attached to it. It is what the system reveals when pressure builds. Modern financial systems do not change through shock. They change through tightening. They adjust how much risk they can tolerate, how quickly they must respond, and how much flexibility they allow. Those changes do not arrive with announcements. They surface through structure. That is why watching institutions at the center matters. Not because they control the system, but because they reflect it. When flexibility shrinks, they show it first. This moment does not mark collapse. It marks transition. History shows that the most important financial shifts are rarely dramatic. They happen while markets are open, while systems are functioning, and while most people assume nothing has changed. Not through fear, not through headlines, but through the process, through design, through structure. Subscribe Economic History.